why is solar going to remain an option for them? I think battery is the new story behind solar. The levelized cost of battery storage in 2024 from 2024 to 2035 over the next decade is going to drop by half. And already this year, it's expected that the battery installations are going to reach 60% of solar capacity installed in 2023. So battery is really catching up and keeping up with solar power installations. And that's what is going to change the game for solar, I believe, and convert it from being a variable source of power to a baseload power. And I think that will make it a lot more attractive yet to all sorts of applications, but certainly AI and data centers. Switching gears a little bit and looking at dependency on silver. Silver, after oil, is the commodity with the single most applications worldwide. So silver, when you say silver is indispensable, it's replaceable in some ways, but as I say, it has so many applications that if silver were to disappear tomorrow, it would wreak havoc on a lot of industry. The U.S. imports 43% of all of the silver that it consumes or requires every year. Bigger picture, if you look at silver versus stocks, relatively, silver peaked in, say, early 80s, bottomed versus the S&P in 2001, peaked in an obvious way in 2011. And if you look at where we are right now, it certainly looks like we're in a bottoming process once again, and that things are looking like they're ready to take off. Certainly the last year has started to make believers out of a few people. Central banks, now this is small, but it's indicative of what's starting to happen. The Saudi central bank just recently announced that it had bought $40 million of the SLV ETF, as well as combined with this Global X Silver ETF. So they're not just buying silver through an ETF, but they're buying silver miners through an ETF. A year ago, the Russian central bank said that it was going to start buying silver for its reserves in the 2025 to 2027 period. I've heard, different numbers about what that might be, but it could be as much as $500 million worth of silver. And so it begs the question, who's next and who may already be buying that it just doesn't want to say because they want to influence prices and they may be looking at it as a strategic move. So here we're going to look at the gold to silver ratio, which is quite helpful sometimes. A great chart by Incrementum. And so the green line in that chart shows you the average since 2000, which was about 69 or so. The average going back to 1970 was about 60. And the average going back to 1900 was about 52. So if you take $3,700 gold today and you use the average going back to 2000, that puts you already at $54 silver. So we're beyond that all-time high of silver, potentially pretty easily, just based on that ratio. And that would mean gold. Remember, that means gold staying at 3,700. I don't expect that to happen either. So the more gold goes up, even if the ratio comes down, the harder it is for silver to keep up. So if the ratio does come down, that means silver is moving even more and even faster than gold is. This is a little bit of a busy chart, but again, bear with me. So this goes back to the late mid-80s or so. And what it tells you is that roughly when the gold-silver ratio peaks around 80, a couple of times, 3 times since then, it's gone above, markedly above 100 around 1980, 85, 88 or so. And then again during COVID, I peaked at an all-time high of 125 and then at 120, about 110 or so again just recently. So when you see that, it suggests that it's time for silver to start catching up. But the best way to kind of look at this is if it's above 80, when it starts to trend downwards, and especially when it crosses through 80 and keeps going down, then you really have sort of the firing pistol to buy silver versus gold, at least, and that it'll rise more quickly. So keep in mind the low in 2011 in this ratio was 30, and in 1980 it was 15. So if we go more conservatively and we take, again, today's, say, $3,700 gold and a 55-to-1 ratio, which I think is pretty reasonable if you look over the last, say, 30 years or so, somewhere around here, 55 or so, That puts you at $67 silver, a 52% gain from where silver is right now. Actually, so this is an incrementum chart. I actually came up with that myself, and they decided to make their own version of it. But what it was the idea was to look at how silver behaves when you get Fed rate cutting cycles. And what I noticed was that the silver price tends to bottom when the rate cutting cycle is about halfway done. We saw that in the early 2000s. We saw it in 2008 and again in 2020. And if you take the average of bottom, so trough to peak in the silver price, as of about halfway through the rate cutting cycle, silver in the last three cycles averaged about a 332% gain. If you look at where we are now, the Fed started cutting about a year ago, then paused, has just started cutting again. In my view, we have just sort of passed that halfway point in the Fed rate cutting cycle. And although silver did start to run earlier this time, it points to a lot of potential upside. If you take the low from 2024, which is, I feel, more fair, when silver bottomed at $22 or so in late February last year, a 332% gain brings you to $95 silver in this cycle. I really think that that could be 12, 18, 24 months out, but I think it's really looking like a serious possibility.
You know, when people talk about the future of silver, they often start by looking backward at old charts, old ratios, old price levels. But what I want you to understand right from the beginning is that the future of silver isn't going to look like the past. This next move isn't just about a cyclical metal rally, it's about a structural transformation, one that's being driven not by sentiment, but by technology, energy, and monetary policy all colliding at the same time. Let's start with something that gets very little attention, but is quietly rewriting the rules. Battery technology. Everyone talks about solar panels, but batteries are the real revolution happening behind the scenes. 10 years ago, energy storage was the missing link, the reason solar couldn't compete as a baseload source of power. But that's changing faster than most people realize. Between now and 2035, the levelized cost of battery storage is expected to drop by half. That's not wishful thinking, that's Bloomberg NEF data. Battery installation capacity is now catching up to solar capacity faster than any analyst predicted. This year alone, the total amount of battery storage installed globally will reach around 60% of last year's total solar capacity. That's a huge leap, and it's the bridge that turns solar from intermittent to reliable. What does that have to do with silver? Everything. Silver isn't just a monetary metal, it's the most conductive metal on Earth. It's what allows your solar panels to turn sunlight into electrons. It's what lets batteries transfer energy efficiently. It's what makes electric vehicles, 5G networks, and even data centers possible. After oil, silver has more industrial applications than any other commodity on the planet. So when you hear people say silver is replaceable, you can laugh politely and then show them the math. Sure, there are substitutes, but they're inferior and more expensive. Try replacing silver in solar panels and your efficiency drops by double digits. Try replacing it in semiconductors and your heat tolerance falls apart. If silver disappeared tomorrow, the global economy wouldn't just slow down, it would collapse. And yet, here we are, with the US importing 43% of all the silver it consumes. 43%. That's not a position of strength. That's a flashing red light of dependency. Now let's zoom out for a second. If we compare silver to stocks, say the S&P 500, the cycles become even more fascinating. Silver peaked relative to stocks in the early 1980s, bottomed around 2001, and then roared back in 2011. Since then, it's been grinding through one of the longest base-building periods in its modern history. The ratio of silver to the S&P right now looks almost identical to where it was before those two massive runs. In other words, silver is coiled. And it's not just retail investors starting to notice. The central banks are waking up. Now I want to pause here because this is a big deal. Central banks historically buy gold. They don't touch silver. But that's changing. The Saudi Central Bank, of all institutions, just announced that it had purchased $40 million worth of the SLV ETF and another position in the Global X Silver Miners ETF. That's not huge money, but it's symbolic. It signals intent. It's the first public move from a major monetary authority saying, we see silver as strategic. And they're not alone. Last year, the Russian central bank announced that it would begin purchasing silver for its national reserves between 2025 and 2027. The initial estimate is $500 million worth. That's not an accident. That's not some quirky diversification move. That's a calculated long-term policy shift away from dollar-based reserves and into hard, industrially essential metals. Now ask yourself, who's next? If Saudi Arabia and Russia are already in, how long before China joins in officially? How long before India, which already has a cultural affinity for silver, begins accumulating on a sovereign level? And here's the thing. Some of them may already be buying, quietly, off-market, using state-controlled intermediaries to avoid moving prices. Because if they announce too early, the floodgates open.
Title of my talk today is Silver is the New Silver. Now, that's a little bit tongue-in-cheek, but the reason I went with that was because silver is known to be volatile, up and down, but can be tremendously strong on the upside and can take a lot of people by surprise. And when it does that, I think until we start to really see that happen, which I think is starting to happen now, I think people forget. And so that's why I think, you can view silver as being silver once again. Just to give you a quick summary of what it's done in the past year and a half. So it bottomed at the end of February of last year, $22. We're at 46 as of yesterday. It's over 105% gain. And then if you want to get a little leverage, you can look at junior silver stocks, and they're up 183% from that same point in time. And typically you'd expect at least a 2-for-1. I think that's coming. I think we're going to see a lot more than 2-for-1 silver stocks versus silver. So it's looking like it's going to be a lot more fun. Just switching very quickly to a little bit of macro. What drives silver? Well, certainly silver is both industrial and monetary. So there's the monetary side of what drives silver, and inflation is certainly a big one of those drivers. And I like to use this data that comes from University of Michigan. They do surveys regularly, and they look at what consumers expect for inflation to be going forward. So we know inflation is at 3%, and consumers just a few months ago were expecting 6.5% a year out. Now they're still expecting 4.8%. That's very elevated. Nearly, we're getting close to double of what actual or reported inflation is. So if you have consumers with these kinds of high inflation level expectations, they're going to act accordingly. And I think that's one of the reasons we're starting to see silver move so much as well. I'm going to go off on what might sound like a little bit of a tangent here because it's not directly related, but bear with me. This is not something that you hear very much about in mainstream media right now, but you have obviously heard about cryptocurrency. There's this thing called stable coins. There are several. And what their intention is to be a crypto that replaces everyday currency, like the US dollar, for example. And the advantages are that it's easily transferred. It's you can transact pretty easily with it. So this largest one is called Tether, and it's worth $100 billion. And most of Tether is backed by US Treasury bills. But what is very interesting is that the CEO of Tether has recently announced that they're starting to shift some of their assets towards what they call tangible assets. 5% of Tether's assets have gone into physical gold. They recently bought a large stake of Elemental Altus Royalties, a gold royalty company. After that, Elemental announced that it was merging with EMX Royalty, which many of you may know. They've been at these conferences before and have presented many times. So now they've merged into a new company. And with that transaction, Tether announced that they would end up being a 33% shareholder of the combined company, and they're going to invest $100 million into this newly merged company for them to go out and buy more royalties, gold royalties. So what's happening? Why is the largest cryptocurrency stablecoin that's meant to mirror the US dollar looking at going into tangible assets?
So let's pick up where we left off, because this next stretch is where the picture really comes together. We've talked about the structural shortage in silver, the accelerating industrial demand, and the reawakening of central bank interest. But I want to take this beyond the charts and the data, because what's happening now is not just a market event, It's a civilizational shift in how the world thinks about value, technology, and independence. Let's start with the technology side again. You know, people hear AI and think ChatGPT, robots, or digital art, but they forget what AI actually needs to exist: energy, and lots of it. These new models aren't powered by fairy dust. They're powered by massive servers that run non-stop, chewing through electricity like a jet engine gulps fuel. The International Energy Agency recently estimated that data centers could consume double the power they use today by 2030. That's equivalent to adding another Japan's worth of electricity demand to the grid. So where does that power come from? It has to be clean, reliable, and scalable. That's solar and battery, and both are silver-hungry industries. Every megawatt of new solar capacity consumes roughly 500 to 600 kilograms of silver. Every new gigawatt of battery storage, lithium-ion, sodium-ion, or solid-state, uses conductive pastes, coatings, and connections that require silver. You see where this goes, right? The more we digitalize, the more we electrify. And the more we electrify, the more silver we consume. And here's the paradox. All these new technologies, the Teslas, the AIs, the clean grids, they depend on a metal that's been treated like an afterthought for decades. It's like trying to run a modern city with plumbing from the 1800s. There's a reason I often call silver the linchpin of the green revolution. You can't build the next energy infrastructure without it. You can't make solar panels, semiconductors, or EVs at scale without it. It's the bloodstream of the new economy, and yet a global supply is falling. That's where the story turns almost poetic in a tragic way, because it reminds me of that old saying, we don't appreciate something until it's gone. Silver has been underpriced for so long that most of the world forgot it's essential. Miners have ignored it, investors have ignored it, governments have ignored it, until suddenly the world wakes up and says, wait a minute, we need this metal to function. But by then, it's too late to ramp up production. You can't just flip a switch and open a new mine. It takes 10 to 15 years to go from discovery to production. That means the silver that will power our energy transition in 2035 needs to be discovered and financed today. And it's not happening. We're living through one of the tightest exploration and investment droughts in history. Mining executives are terrified of ESG backlash, rising costs, and government interference. So they're cutting back. They're high-grading existing deposits instead of developing new ones. That's why even though prices are rising, supply isn't responding. And here's the funny thing. Every time silver breaks out, analysts scramble to find an explanation. They'll say, oh, it's speculation, or it's ETF buying. No, it's not. It's the laws of physics and economics finally catching up to years of neglect. And let's not forget the monetary side, because this is where things get explosive. Silver is the most misunderstood monetary metal in the world. It's not just poor man's gold. Historically, silver was the world's currency. From the Roman denarius to the Spanish pieces of 8, from China's silver taels to America's silver dollars, silver was money for 2,000 years. Gold was for kings and vaults. Silver was for trade, for civilization. That legacy doesn't disappear. It's just been sleeping. And I believe it's about to wake up. You see, as gold reasserts itself as a monetary anchor for central banks, silver becomes the logical extension of that for private citizens and industries. It's the bridge between the financial system and the real economy. You can't run a global trade network on digital currencies alone. You need hard assets that settle value. That's exactly what we're seeing with the rise of the mBridge and BRICS payment systems. This is the quiet revolution that most Western analysts are still dismissing as symbolic. But it's not symbolic. It's functional. 11 countries in Asia are already transacting on mBridge, bypassing SWIFT, settling in local currencies, and soon in gold. Hong Kong's new vault is operational. Saudi Arabia's is under construction. The United Arab Emirates and Singapore are preparing theirs. The next layer of this will be commodity-backed digital settlement, where nations can trade energy, food, or manufactured goods and settle the balance directly in gold or silver held in a neutral vault. This isn't science fiction, it's happening. And when you add silver into that system, when central banks start to diversify reserves with both gold and silver, you unlock something entirely new. Because silver has a unique duality. It's both a monetary metal and an industrial metal. It's liquid, divisible, and useful. That's why Saudi Arabia's purchase of silver ETFs matters far more than the dollar amount. It's not about the $40 million. It's about the signal that silver is being recognized as a strategic reserve asset. Think about it. For 50 years, gold was the hedge against fiat risk. But now silver is emerging as the hedge against energy and supply chain risk. It's the metal of independence, both financial and technological. Now let's connect this to the Fed, because every rate cut cycle in history tells the same story. The deeper the cuts, the higher silver climbs. And we're in the middle of that process right now. If the Fed follows through on its current trajectory, we could see rates back at 2% by next year. And when that happens, real yields go negative again. Inflation-adjusted returns on cash and bonds vanish, and all that money sitting in money market funds starts looking for a new home. Guess where it goes? Into hard assets. And because silver is still undervalued relative to gold, it becomes the natural torque play. It's the leverage without leverage. That's why in every previous rate cut cycle, 2001, 2008, 2020, silver's performance blew past gold's. It doesn't just climb, it erupts. From 2001 to 2006, silver rose 400%. From 2008 to 2011, it went up 500%. From 2020 to 2021, nearly 150%. And that's before the fundamentals we see today even existed. Back then, there was no AI revolution. There was no global energy transition. There weren't central banks talking about silver. There wasn't an 11-country digital settlement network backed by gold.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.